Welcome to Building Bridges. Thank you, of course, Emmanuel and David, for exchanging today with us on a topic that is quite an actual topic, which has to do with the fiduciary responsibility. The fiduciary responsibility has been discussed in many senses. It's been a bit technical, perhaps artificially exaggerated from time to time as well, but it has usually been associated with the idea that one should, in our profession, maximize excess returns if possible, for the benefit, of course, of the clients and investors. Now, more recently, with the changes that have happened, in particular with regard to the planet protection and nature protection in general, we've seen this notion of fiduciary responsibility touching on environmental issues, on nature issues, on social related issues, etc. And it nearly becomes now sort of an obligation rather than a constraint to get into those criteria before we decide to invest for the benefit of the client. So it might be interesting to discuss a bit this issue from different angles and have your different views. So if I may, I will start with David. Generation has long argued that sustainability was integral part of investing. How does fiduciary responsibility really align with this view today? I mean, is this changing, or is this very true still?
Well, it has evolved over the last 22 years. I can't believe it, but we founded Generation 22 years ago, which that was even before the term ESG existed. And as we were getting started, the first thing we did was actually ask the lawyers whether integrating sustainability into an investment process was permitted. And so we clearly needed to be sure we were fulfilling fiduciary duty. And the lawyers came back, and actually we ultimately wrote a paper about it, said, yes, you can include sustainability if it is relevant to the long-term success of a business. And as time went on, over the course of the first 5-10 years, what we actually began to realize that is if you don't include sustainability into your investment process, you are not fulfilling your fiduciary duty. And I think more recently, people are beginning to understand that the term fiduciary duty is helping your clients, your stakeholders, your fiduciaries fulfill their ambitions. And their ambitions, particularly from a long-term perspective, may also include a world that is addressing the challenges of climate, nature, and poverty and inequality. And therefore, increasingly, the notion of impact is becoming part of fiduciary duty conversations. So it definitely has evolved over these 22 years.
And the trade-off between return?
The first question is, by definition, is sustainability a trade-off? We have never thought that we're trading values for value over these 22 years. And in fact, again, we believe that understanding what drives the long-term success of business, understanding that sustainability challenges, whether it be nature, climate, or people, are relevant to the long-term success of economies, and by extension, important to the relative success of businesses. And so to do your job, to deliver appropriate risk-adjusted returns, you must include sustainability in your analysis.
Emmanuel, as an important, large institutional asset owner, how do you embed sustainability into your process? How do you view it, and how do you define it?
Well, much like David, I think if I go back to the law that created La Caisse, the EBQ, which is 60 years old, the founding father didn't have sustainability or ESG at all either in mind, but they gave us a mandate to maximize the return for our pensioner. There's two words. We have to be prudent, and it has to be profitable. So I'll come back to that. And there's actually a dual mandate, which is quite uncommon. So we need to maximize return, and we need to support the economic development of Quebec, the province of Quebec in Canada. So it's an end, which is interesting, and maybe we dig some more into that. So we don't think that sustainability by itself is part of our duties because it's not written in the mandate, but we deduct it from our mandate, and to make sure that the employee, our management of our portfolio company, everybody's on board. We go to our clients with a question: do you want us to do it? Fortunately, all our clients are in Quebec. 47 clients in Quebec. So it's relatively straightforward to access them. And there's some form of homogeneity in what they want. But even then, it's not always the case that all of them want to focus on such a short aspect of sustainability as a whole. So for us, it's really a deduction from our financial duties. And we've embedded since 2018, we picked one in particular, decarbonization, just to spearhead a little bit this change in mentality. Because it's, I immigrated from Europe where it was much more intense, this topic. Arriving in North America, that was not a core topic 8 years ago. I think it grew. But so we picked decarbonization and we embedded it into everybody's bonus payment, everybody in CDPQ, about 2,000 people. And so it became really part of our ethos and the way we operate and how we look at it through a risk lens in what we invest, convincing ourselves through our long-term business plan. We are a buy and hold investor, so we like to think we know what happens in 50 years' time. And we need to figure out how we deal with the asset that we buy in this time horizon. And then that's easier to build in some sustainability, because you have a longer time horizon to justify financially and economically why you take some long-term bets or you don't, or you de-risk your assets through more resilience investing.
Perhaps a question to both of you here. Do you think that investors in general are still divided on this issue of fiduciary responsibility? And how do you resolve or want to resolve the issue? Because you might not always have to talk to the same investors with the same view, being completely agreeing with the approach that you've taken in your investment strategy. So how about bridging, if I may say, those points of view?
I'll start, David. Our clientele is much more homogeneous probably than yours, but we've recently extended our reach to Switzerland. So we have about 16 pension plans of Switzerland joining us and co-investing alongside our infrastructure mandate. But it was a reverse selection. They had to fit within our sustainability horizon for them to become potential clients and vice versa. So it was kind of a reverse selection. I don't think we could work with a client that rejects our sustainability initiatives and goals, because that would create some tension, I think, there. But I think you and probably David have more.
No, we would agree as well. So I think first it's appropriate to say that all clients will have a different view on sustainability and fiduciary duty and actually ambitions. And that's okay. Understanding what the broader mandate is for each client is critically important. But we also believe that all of our clients are committed to sustainability. Otherwise, they wouldn't want to be our clients. But I think the issue now in some places, and it's North America, and actually, unfortunately, it's south of Canada, has fiduciary duty after 22 years. I am surprised it is now a question. For a long time, we had hit this on the head where people understood that sustainability was relevant to the long-term success of business. Increasingly, we have to remake the business case that sustainability is relevant to the long-term success of business, and by extension, a risk and return matrix and proposition.
So in this respect, ignoring sustainability would be a breach.
We believe absolutely. In fact, I sit on many investment committees, and I can't imagine not including sustainability in an analysis of an investment opportunity. There are now states in the United States that suggest that you cannot consider climate change as part of your investment process. And there's even been certain legal rulings in the state of Texas that implies that would be true. And yet that is completely counter to your fiduciary duty. If you are a real estate investor in Florida, for example, understanding the impacts of climate on your coastal portfolio would seem to me to be a pretty good idea, all things considered. So I think we need to move past politics and sort of silliness and into what are the core business fundamentals that are driving the success of businesses over the long term. And there are many factors. There is quite broad, but broadly speaking, sustainability is critical to assessing that company or that economy.
Well, you mentioned you mentioned it. You're speaking about investing for the long term, and probably, but tell me if I'm wrong, some of the trade-offs come precisely from this issue of the time horizon, where, shorter term types of investment strategies may be performing better than long term for reasons that have to do with the current circumstances and perhaps nothing to do with the inherent sustainability of the investment proposal. And yet investors continue to sort of be fighting against the two, and it's not very easy to convince an investor to go for the long term when short term's performances really outperform.
I'll go first, but he will have a very good answer because they are long-term investors to the core. Long-term investing
For us, for sure.
Yeah, long-term investing is best practice. We've known that for many years. That is, every corporate finance book, every investment book will talk about this. And in fact, one of the reasons why we established Generation 22 years ago was that we felt that the markets were too short-term oriented, and it was an opportunity if your clients gave you the mandate to invest in a way that was counter to what the herd was doing. It's worse today than it was 22 years ago, but it's still a very bad idea to be investing on a short-term horizon, because you're likely not to take advantage of the long-term compounding of great businesses or great investments. Plus, often if you're thinking of the short term, you're in fact a trader. And many investors don't have the same skill as a Goldman Sachs trading desk or a UBS trading desk. So it's never been clear to us why focusing on the short term is a good idea. Though right now, momentum trading has been very successful for the last couple of years. It's very difficult as a long-term fundamental investor, but over time, we have no doubt it is a superior way to deploy capital.
If I can add, yes, I think for us, it's relatively easier. But even though, we measure our performance on a 5-year average performance, so it helps lengthen the stress of quarterly reporting, for instance. But nevertheless, we don't actually count a quarter, but you miss a half year, then your strategy becomes challenged, and you need to re-explain. And, fortunately, in the infrastructure portfolio, we've been long-term and we managed to keep a satisfactory level of performance. I'm just conscious that if I underperform a couple of semesters in a row, I'm going to have to justify myself again, and I think I can and I will, and our clients will back us. But there's this duality, we need to make sure there's money in 30 years' time to pay pensions. But at the other hand, how do you benchmark our performance? Because it's a little bit too easy for our investment team, and my team included, to say, we're long-term. Doesn't matter what's happening now. You can say this maybe once or twice, but after some time, you're going to get hit, by a hard question, or are you a joke, So this is a challenge. I do think that the industry around closed-end funds is relatively harder to embed sustainability in the investment, because it's more like a game of hot potatoes. You're holding an asset, and after maybe you buy a year or two, year 6 or 7, you're thinking of exiting already. So even if it's a dirty asset and you haven't invested in R&D, in health and safety or cybersecurity, you pass it on to somebody else who's going to have to deal with a problem, and probably the valuation is hit a little bit, but as long as the music is still on, you can pass it on to another party. When you're in a pension plan or, open-ended fund, you have to deal with a problem because they're not going to solve themselves. So I think is implicitly, when you're long-term, you have to look at those longer-term issues and fix them. But nevertheless, you still reminded that short-term, expectations are there. So it's not as easy as David is hoping for us to invest.
But at CDPQ, you're pretty much investing and specializing investments that have to do with, for instance, infrastructure. Long-term is, of course, embedded in infrastructure. How do you incorporate this notion of fiduciary duty in the infrastructure? I wouldn't say asset class, but at least the investment strategies.
So it's about 70 billion Canadian dollars, so call it 50 billion euros, our portfolio. So it's about 40 portfolio company, and we tend to buy control, direct or co-control. And so, in a way, it's our responsibility to operate them having in light or in mind our fiduciary duties. So, you can't fight all fires at the same time, and we're all agents in this. So, I'm an agent from my clients, and my team is an agent. The people we put at the board are agents, and the management is an agent. So there's a chain of responsibility I need to be able to bridge. So we are only pushing call it 5 big initiatives. The first one I mentioned is decarbonization. So, infrastructure has been, and in the world is the biggest CO2 emitter, and when I joined 8 years ago, I was the biggest emitter of the entire CDPQ portfolio, which coming from a renewable developer was hard, and so we work, we got a carbon budget, and I mentioned the bonus adjustment. So we got everybody in line and managed to decrease, overinvest probably in renewable at probably the right time. And that was relatively successful. Second one is health and safety. I work in a utility, and it's front and center. You deal with your employee, users. Health and safety is paramount to the well-being, and it proves that your business is well managed. And so I think this is kind of the S, if you want. And that was for me. It's where our duties as a financial investor meet our duties as shareholders and owner of assets, and the responsibility we can have with our employees. The second one, which is slightly more debated on our side of the Atlantic, is equity and inclusion. And for us, it's paramount. We represent 6 million Quebecers, and we invest their pension. And in a way, the workforce need to mirror a little bit the workforce of Quebec. So infrastructure has been a male business for a long time. And so how do you turn that, invest in new management talent at the portfolio level? And one story, just to show that it ties to returns as well. We own quite a few ports across the world, and traditionally male working ports for historical reasons that are completely absurd today, where it's mostly automated. And we brought in women, and we forced women to join. I mean, we forced management to hire women, I should say. And gradually, maybe there's a fulfilling prophecy. They say, well, it's great. Actually, we changed a little bit the workload. It's shorter, more efficiency because people work less, and we attracted a lot of women. It's an industry where we lack people, and so it opened up a new circle of people we can hire. So it was viewed very positively. Second one and third one is fourth and fifth are cybersecurity. I mean, it speaks to you're gonna get hit at some point. So either you fix it or you cross your finger. And we had a bad experience owning a pipeline that got shut down by a by a cyber attack, and it's you don't want to have it a second time. So we learned from this. And the last one is climate adaptation, which is probably still the one that is most easy to push in North America because it speaks to risk and it speaks to the consequences of catastrophes today. So that's one that we push hard. It's how do you make sure your asset resists climate change? It's kind of sad that we invest money and resources and time on this rather than fixing the climate. But the truth is, this is one of the big vector of investments today is how do you fix your assets and prepare them for what's coming?
But what Emmanuel is talking about is all about business. It's all about driving best practice business. It's not about values. It's not about imposing what he believes on the portfolio. It's what does it take to run a smart infrastructure business? And that's the point we need to keep making when we make the fiduciary duty case, when we make the investment case, that this is just smart business. This is how you run great long-term businesses.
But Emmanuel spoke about different areas in which this sustainability fiduciary duty is particularly present, and that's translated into the current realities. Where do you at Generation see the biggest, I would say then, business opportunities which combine these sustainable factors with, of course, the normal profitability factors that you're looking at?
Well, so we look across economies and across industries. And so we would be investing in businesses that might be focused on nature or the environment. We would be investing in healthcare businesses. We would invest in businesses that might have more of a consumer presence and more people presence, both publicly and privately. And we don't tend to look at themes, if you will. We tend to look at what are the very best long-term businesses, particularly in our public portfolios. But I think the area that increasingly needs focus are areas that have, in the case of carbon emissions, the highest carbon emissions. And if you can find businesses that are heavy emitters and then management teams or innovators that are driving the reduction of those emissions, then you are having an extraordinary both investment opportunity as well as impact on where we need to go to decarbonize our economies. Similarly, and increasingly, this is getting some pretty interesting press or feedback. We need to find ways to catalyze capital to the global south. There will be significant opportunities and, in fact, requirements to invest in the global south over the course of the next 10, 15, 20 years. And using sustainability to drive sort of the greening of these supply chains, of these economies, could be a very interesting place to deploy capital. So I think the answer is you could argue, well, maybe supply chains or circular economy, but it's all the above are interesting places to deploy capital and increasingly urgent to deploy capital.
Seems to me, having gone through the Building Bridges community in the directions of better understanding how those emerging or new frontier markets could offer a solution, seems to me that there are examples in these regions of the world of transformative investment opportunities that really worked well and could actually be replicable anywhere else, isn't it? What since you opened the door to that subject that is also dear to our considerations at Building Bridges, what would be the main constraint today? What are we missing to be deploying capital more effectively, for instance, in the emerging markets? As demand, indeed, you're not the first to say so, demand is there. People are basically, big investors are basically asking for opportunities and how to use those opportunities to deploy capital. What is missing?
Well, what's missing actually is, to be honest, a mindset. So historically, deploying capital in developing economies has been extremely hard. And a lot of folks have lost a lot of money in emerging economies, often because of challenges around exchange rates, sometimes because of rule of law, sometimes for other reasons. And so we do need to address those challenges. But yet, multinational businesses, infrastructure investors have been deploying capital for years in the global south. And so we need to develop case studies and perhaps even tools to address those challenges. And certainly the major development banks are onto this. They know that they have to do things differently. They know they have to provide facilities or insurance or currency exchange mechanisms or even first loss guarantees to help change the mindset of investors in the Northern Hemisphere.
Yeah, it seems that those multilateral development banks are the ones being today called for action.
Yes, and they have historically been slow to act, but they now get it. I think they fundamentally get it.
I'll add a couple of things. When you look at the data, it's hard to beat investing in the US, especially in infrastructure, No thesis works. We should just have invested all our money in US infrastructure. If you look at last 10 years, anything you do, call it for diversification, has been, you've bought some diversification, but it's cost you, and investing in emerging market, for me, when you manage a pension portfolio, that's useful for diversification, but it hasn't paid off, but same, investing in Europe hasn't paid off. If you look at the data, just invest in the US, don't worry about the rest of the world. It will pay off at some moment. I'm convinced. And that's why I'm kind of forcing ourselves to invest in emerging market, because to your point, David, it comes with an extra complexity, and when you're going around investors, more often than not, that's excluded. You have to invest in OECD countries. So whenever you move away from this constraint, you get small allocation, you can do 5%, 10%, you have to debate it. We just bought a big renewable developer in US, mostly in Canada and in the US, but it has 15% of its business in Chile. Frankly, I don't know. For those who have been in Chile, it's they like to think they're the Switzerland of Latin America. I let you judge of this here, but that was a big issue for some of the investors that we wanted to bring along on our deal, and that feels absurd to me. It's just, they have this constraint, and changing those investment policy takes years. They need to go to their board. So there's a lot of inertia, I think, that doesn't help. And, past performance hasn't demonstrated that's something you should do. So that's for me, that's a challenge. I'm kind of not hopeful because that would be, but in today's turn mode, I think this diversification will be valued and rewarded.
With what kind of time horizon? See, I'm asking the question because, of course, the investors will ask you, is this part of your responsibility to tell me that in 50 years you're going to be right?
Well, 50 years is a long time. How about 5, 10, 15 years?
So you think it's going to show?
Absolutely, yes. Absolutely, yes. And the way I would say it, and this now may seem that I'm imposing values, but it still resonates. If you're a pension manager, if you are going to deliver in 10, 15 years time, so 2040, 2050 isn't that long of time away. I mean, we started Generation 22 years ago. That seems like it's yesterday, but it's 22 years ago. If we deliver a world that is 2 degrees or 3 degrees C warmer, a world where we've destroyed ecosystems, in a world that is significantly unequal, have we fulfilled our fiduciary duty to our stakeholders? If they're living in a world like that, I would argue we have not fulfilled our fiduciary duty. And so that's the time horizon we're looking at. We're not talking about 75 years. It is imminent. This is within the time frame of capital allocation. It's just not next week.
Can we move perhaps to a slightly different angle to the discussion, which has to do with the framework within which we all operate in this issue of fiduciary duty, which is the regulatory framework. Well, let's start with the North American framework. I won't maybe assume that it is the same in America than it is in Canada, but do you think that there is let's discuss the strengths of this current regulatory framework now, and how about, is it a framework which facilitates, or is this a framework that renders, on the contrary, more difficult investing sustainably?
So it's a loaded question and loaded answer because it's changed a lot in the last, I would say 18, 24 months. And there was another op-ed in DFT this morning from the SEC chair. So this is the way it's going to go for the next few years, which is, kind of a backslash. It's not listening to reason, like David was explaining. You can demonstrate rationally what you should do. This is politicized, and this is rewinding the tape. If I can use this metaphor. Speaking of Canada, Canada is, slightly slower, but on the same trajectory as Europe to make things, it's TCFD like the UK. We don't have CSRD like Europe, but philosophically, this is a logic. More disclosure, for instance, for public market is going to help, traders and investors in general make the right calls and establish maybe just themselves that those companies that deal with this in this way are better performer. And no opinion there, no philosophical views, just hard data. I'm convinced when you operate in a more sustainable way, we generate more return. It will get materialized through data, and that's what's needed. So US, reversing its course totally, Atkins going against any form of disclosure, even actually no more quarterly reporting, if I read correctly. So that might be slightly more long term, semestry reporting now.
Okay.
So that's really, that said, if you look deeper down at regulation, I'll just tell you a small, very sad story is the polar vortex in Texas, red state, Texas, that David mentioned earlier. 2021, freezing temperature, minus 20 degrees Celsius, 200 casualty, people dying, gas plants shut down because they are not weatherized, wind turbines shutting down because they're not weatherized. Actually, we had a couple of windmills that shut down because they weren't weatherized. People dying, no electricity, no heating. So it's not that expensive to weatherize plants, now it's done. on our part at least. But, Texas established a regulation, imposing this weatherization, creating a reliability police, basically, making sure those assets are going to resist polar vortex. So even though there's this backlash and this, at the local level, for resilience, things do still move, And again, rest of the US, there's other states that are far more proactive in this topic. So federal level, clearly, rewinding the tape, but at various local level, hardcore evidence helps move things a little bit forward. But, we're expecting, a long winter there. Yeah.
I think the law is clear in the United States that as a fiduciary, you must consider the long-term objectives of your client or the objectives of your client, and you must consider all risks and opportunities associated with that. That's been true for a long, long, long time. And what you're seeing is an overlay, as Emmanuel said, sort of a winter of politics. And it's noisy and frankly, it's a bit oppressive. But as a capital allocator, we need to just be maniacally focused on innovation and on driving long-term risk-adjusted returns and what makes sense from a business perspective, and just not worry about the noise. And that's true in Europe as well as true around the world. The reason why I'm frustrated about relitigating fiduciary duty is that the rules haven't changed. They're still the same. It's just that some number of politicians are trying to make it seem different. And I will tell you that a number of red states who have pension managers are pushing back on this also because they know the rules. They know what their responsibilities are. So there's a lot of noise, but the core fundamentals of how you deploy capital, how you allocate capital haven't changed, actually.
Do you think in Europe, the direction of the journey is...
I think it is. It's also clear. Yes. Now, there are times where regulatory frameworks can be more extensive than they are, say, in North America. And there's been some readjustment here in Europe, actually, or in the European Union. And those are ebbs and flows. And by the way, the sustainability community has done an awful lot to confuse things as well in terms of acronyms and different reporting regimes, et cetera. So we should fix all that. But the core fundamentals of how you deploy capital, how you think about capital allocation really hasn't changed. And it remains robust and best case, or not best case, but just strong business practice.
You think regulators are lagging behind the reality in this respect?
No, I don't. I think regulators are, I think they are refining some of their positions. And I know you and I've talked about this in the past, and there are instances where it's nonsensical, but mostly we're traveling in a positive direction. And I think you've got to obviously abide by regulation and law, but you also need to be thoughtful about what is the construct of how you're deploying capital. And as I said, those are clearly rigorous, and they haven't changed.
There are regional, of course, differences. We just alluded to some of them. Where do you see the leadership taking place today? In this respect, if you look at Asia, for instance, it's quite interesting to see that Asia is starting to adopt their criteria in their decision-making process for at least the big institutional investors that are quite leaning in the right direction, it seems to me, perhaps more even than we do in Europe and in North America.
But I think it's not so much, West versus South or East, or it's now you got in, as David said, it's just good business. How to make money. You need to think reasonably long term, and either it's the financial markets who do it, and regulators can help, or it's private markets. I think it's our responsibility, being in the private sectors, to be grown-ups about it, ask for the data, fix the companies, invest, talk to governments. India has spearheaded like a government recycling program where they help foster infrastructure investment in renewable through auctions, through building and recycling projects. So it's it's quite done systematically, and I think there's hope. We were quite involved with Indonesia as well. I mean, they're still building coal plants in India, but they are massively building renewable capacity, thinking strongly about how you build up the grid. We are very active in Brazil as well. It's well organized. I think I'm quite hopeful. It doesn't necessarily take a leader like it did in the past. To your question, do we need the European flag? I think the South will find its solution. Do you realize way more on subsidies than it did in the past? I think, especially for carbon. I think for the rest, it's about good businesses. So it will come naturally. It will emerge. In Australia, it's very proactive as well. So those pockets will create the change. I'm quite hopeful there. Yeah.
Is innovation, which we see happening in practically every industrial model or system, is innovation there also going to change considerably the investment opportunities and the universe for sustainable investing?
Oh my goodness gracious, absolutely yes. The innovation, the entrepreneurs are absolutely driving sustainability into our economy, whether that be energy storage, whether it be solar, whether that be wind, whether that be other forms of clean mobility. It's happening. And the innovators, the entrepreneurs are amazing. And that's actually why when President Trump at the UN last week said, the climate change is this big hoax and Europe, please stop investing in green. It's really not a very thoughtful approach, because ultimately greening our economy is cheaper. It creates jobs and it creates security, and it's better in terms of pollution, et cetera. So what we're talking about is a sustainability revolution there's ebbs and flows, and there are instances where it may be more expensive in the short term, but ultimately what we're talking about is driving our economies to a better place, driving businesses to a better place, and entrepreneurs as well as CEOs of major businesses get this 100%.
If I can illustrate David's point with solar, after my MBA, I joined a renewable developer 20 years ago, and we pitched to the market, we do a capital increase, 500 million to do solar, and we went to all the pension plans of Europe explaining, you take a photon, you put it in a box, it creates a euro, that was simple enough. And we raised the capital. At the time, we were building worldwide 1 gigawatt of solar across the world every year, 99% in Germany and Spain, massively subsidized. 5 years later, it was 1 gigawatt a month, Another 5 years, it was 1 gigawatt a week. Today, last year was 1 gigawatt a day. And interestingly, 80% of that was done in emerging market. So, it's unstoppable, whatever anybody in the Western world says or act, even if Europe listens to the UN speech and acts, it's unstoppable. So I see the same thing in battery storage. We see the same thing in electric car. Now it's unstoppable. So, that gives me some hope, that innovation can drive change. The downside of this, and I'm always worried, this is not the only solution. If you don't make the right policies, you cannot hope that technology will save the planet. I don't think that's the right approach to have. I think it takes actions today because they are far cheaper today than they will be in 20 years' time. That's my personal view, and it's a political view, if I can say. But so it doesn't change the fact that investing in renewables today is economical, is done without subsidies, and it's unstoppable. So innovation to that extent is quite key. And the people not in my space, I don't invest in totally risky things on that front. Those that help develop those new technology are essential, and they should be protected and subsidized to make sure those new technology see the light of day and gets the economy of scale effect.
In order to have sustainability become really mainstream, probably some of these objectives that sustainable investors are looking for have to be better understood by the politicians, by the regulators, not only by the investors that usually follow their good advice, but also by the general public. There's a gap here to be filled, and the gap comes probably from this trade-off between short and long term as well. In the shorter term, there's going to be a need for massive investment in order for this transformation to get realized. Nobody will necessarily say that this is not a good thing, but many will say, I'm not going to pay for it. Isn't that part of our fiduciary responsibility as investors looking at sustainable investing as the way to go? Also to communicate a bit differently, I would say, to the public, which ultimately will elect the politicians who make the regulators, etc. How should we act in a different way or in a better way in order to convince the public to support, I would say, some of these directions?
Well, the first thing to share is this is the third time in 20 years that we've seen a pause in sustainability. So this isn't the first time, this is the third time. And each time we've seen it, we have seen sustainability return further down the road and more robust. And it's because actually this is the business case. It's unstoppable. The innovation that's driving this change and the entrepreneurs and the businesses behind it continue to drive for just better business models. And so it will get back on track undoubtedly. And actually, one thing that you could say to Mr. Trump's speech, and the Chinese certainly are saying it, is thank you. Please don't invest in sustainability because it just is better for us. It's cheaper. We're going to have better returns. And that has been true for many years. But the point you made is also true. I think we in the sustainability community have done a terrible job communicating. We make it too hard. We have too many acronyms. We need to really think carefully about the message that we have and revert back to ultimately this is about better business models. This is this is more jobs. This is more security. This is just a better way to run our economies and to drive long-term risk-adjusted results.
I think a lot of it, I hate to just ask a politician to do things because that's always the easy solution. But I think it's a politician job to explain. I don't think it's a financial investor job to explain. First of all, we don't speak the right language. To your point, David, I think it's full of acronyms and people are, I don't think they think that, our fiduciary duty makes us less reliable because we're here to make money. You hear that a lot. Or you're just financial investor, you're here to make money, And it takes a lot of explaining to turn the tide. So I think it's a politician job, personally. We can help come up with good examples, good photographics, but at the end of the day, nobody's listened to read our sustainability reporting, this kind of thing. I think it really takes a politician to make it their own. So what can we do? One example that we just invested in, we've been talking to UK government for 18 months. They want to deploy more nuclear power. I know it's not a great topic in Switzerland, but, we convinced ourselves that it's good decarbonized energy. And it's been the politician job, and they've done a pretty good job at it, explaining that it's going to lower the bills of UK consumers. It's going to make their grid and electricity safer and more reliable because, piping gas from Russia is not a great idea in these times. So, all this is a politician's job. I'm not going to be on stage explaining why they should build a nuclear power plant in the UK, not suicidal. So they had to make the job, and they convinced most of the people they were the right thing to do. And then we're coming in with our, funky acronyms, etc., trying to make the math work for us in terms of risk and returns. We want dividends, going to take 20 years to build. How do we address it? The structuring part, we can help, making sure the cost is limited. I think to limit the cost, you want financial investor involved in this big project. You don't want too much of their capital because our capital is very expensive. So a lot of public money, a little bit of private capital, just so we incentivize enough to put the right governance. I think that's a kind of winning combination, but I'm not going to go and defend this project. It's a politician job, in my opinion.
You think one of the difficulties also that we may have in accelerating enough this trend towards sustainable investing may come from the fact that we're making a sustainable investment sort of a niche investment rather than a mainstream approach or investment strategy process. In other words, we qualify through the products, those of the products I'm talking about, typically mutual fund and typically Europe. We qualify those that are and those that are not completely or partially green or brown, etc. So at the end, we try to qualify what is a good or a bad company instead of trying to understand what's the impact of all we're discussing on the financial of any company, whatever the sector is. Is there something to be done in this respect to sort of alert? You're talking about the politicians, about this easy way to sort of qualify sustainability, which turns to be probably an obstacle to mainstreaming some of what we're trying to do.
We discovered this because we had we wanted to, in 2017, to go green, so building renewable, building great buildings, green transport, green everything. So we committed, going north of 30 billion in that. We ended up being north of that, but we realized that more and more our portfolio was a little bit what you just described. Looking through a tiny hole at the market and being oblivious of 80% of the investment that we could be making. So we announced this year a change in perspective. We decarbonized the portfolio by 70% ahead of. So it's not turning around. It's just what do we do for the next 5 or 6 years? So 2030, now we're talking about 400 billion. So probably 2/3 of our portfolio. There's going to be action climatique. So it's not just green. It's not just shutting down coal plants. It's also taking any company, farming, chemicals that we need, anything, building offices, and, helping them move toward a path of decarbonization, So, and we pick SBTI, another acronym David will love. So science-based, maybe it's less fashionable these days, science, but still. And our objective is to take some of those businesses and make them go into the right direction, even though they're not clean already, and that's actually more powerful. And to your point is now we are talking about 85% of the world companies that we can talk to and try to include in our action. So I completely agree with you. If you're too autistic in how you describe what you want to do, then you're missing the bigger picture.
One thing I would say too, to build on what Emmanuel was saying, is 20 years ago, the term ESG did not exist. 20 years ago, at most 1% of the market was thinking about sustainability. Today, you have to work very hard to find a capital allocator who isn't one way, shape, or form thinking about sustainability. And most don't think of it as sustainability in one bucket and then regular investing in another bucket. We, from the very beginning, have said it's just the same. It's just best practice investing. And I think, again, reiterating that this is about economics, this is about best practice investing, and stopping the notion that sustainable investing is a product. It's imposing values. It's just fundamental common sense investing. I remember when we first started talking about this 20 years ago, I gave this presentation to a very sophisticated investor, and they looked at me and said, "This is just common sense." And I said, "Precisely."
Well, thank you very much, Emmanuel and David, for this very interesting discussion. I think perhaps as a last quick question, how does fiduciary duty look like 5 years from now? Is this legally binding? Is this completely embedded into the normal responsibilities of the professional investors? How would you see this duty evolve?
Well, it is legally binding. Sustainability and fiduciary duty are legally binding. I wonder whether impact will become more prevalent in how we think about fiduciary duty.
I'm hopeful. Let's leave it at that. It's going to be totally mainstream. As we're deducting it from our financial duties, I think it's going to become mainstream, and we won't have to mention it. I think, as David said, everybody's already talking about it. I don't think everybody does it right, but hopefully the ultimate owners will be able to distinguish the good from the bad, and so it will become mainstream because it's obvious,
Thank you for joining me for this very interesting conversation.
Thank you, Babu.
Thank you. Thank you.